Hi there, traders. This is Brad Gilbert with the Daily Market Insight for Thursday, the 10th of August. Now, finally, the US CPI numbers are upon us right now. This is what the market's been sort of waiting for probably a couple of weeks, right? In particular, this week, each day seems to take like a couple of days as everything slows down leading up to the numbers, because this CPI number will have a big impact on, or it could have a big impact on the Fed's forward guidance. And what we're talking about is, do they sort of lean towards raising rates again, or, you know, that side of things? Or do they get a weaker number and then start to sort of play a sort of backward roll? They don't want to give the market too much, but you know what? The pressure will really be off interest rates. So this is where we are. And this is, I'll tell you what, out of all the numbers we have, right, this is at an ideal time, technically, and I'll show you these numbers in a second, or the charts, I should say, but we've got really good positions technically. So we're going to get a movement one way or the other. In actual fact, I haven't seen this good for a long time, where you could just go in with bracket orders here, pending OCO entry orders on both sides of the market, because if we get a variance, right, so the consensus is, previous number was 4.8. The consensus is for 4.8. And even Trading Economics have come out with their forecast of 4.8 there as well. Now, if it's weaker or stronger than this number, then it's going to set wheels in motion. Higher inflation numbers, lower equities. Okay, higher inflation numbers, higher US dollar. It's that simple. And you can roll that out across the financial markets. Now, we are talking about, okay, 4.8, but if I just come into News Squawk, understanding the range here is super important. Okay, you got the low and the high end of the forecast, 4.6 to 4.9. Now, 4.8 is the forecast, right? What we're looking for is a number below 4.6 or above 4.9 to really get the market moving, right? And the range for this data has really contracted, right? The market is very confident with the numbers. So, you know what? We get a 4.5, the dollar craps out, equities go through the roof. We get a number 5% or above, okay? The dollar will go through the roof and equities will get hit. It's that simple, right? And what I'm talking about is with the market itself, okay, the positioning of the market. Now, if you look at the global markets, the Dow, sort of like chopping all over the place, right? A bit of repositioning. If anything, it's breaking down, as has the S&P, but the NASDAQ to me is the key here. Okay, really strong numbers. So 5%, 4.95%. The equity markets will get hit. The market is super long, the NASDAQ. So I would see a massive clean out. That should drag down the Dow Jones and the S&P 500. Crypto is sort of just banging away there. You can see here, as we go along, like oil is back in that uptrend. It is having the occasional false break on the downside. Gold also worked through these 1, 2, 3 support levels. It's heading down below 1900. And you know what? A weaker US number here will go a long way to sort of taking the pressure off any sort of safe haven trade. And Euro, well, it is trending down and we're right on this sort of key level. Short term, the dollar index has been moving up, but this is the key to it, right? Because you look, this is a like a policy related trending sort of number, and it can change the trend. To me, the numbers have been coming in weak. Now we've got the dollar index, okay, euro. Actually, let me just come over to the currency page. It's a bit easy to go through. What I'm going to show you is basically there's a whole range of instruments here right on critical levels. Okay, dollar Swiss, dollar index, dollar yen, dollar CAD for that matter, euro, sterling is just through the level, but waiting to move either way, as is Aussie, and the Kiwi's a little bit lower there as well. So these are all on a knife edge, most of them. Some of them have broken down, right? So you've got a little bit of a breakdown here on sterling, the Aussie and the Kiwi. The euro is super primed, right? As is dollar Swiss for that matter. I like these two pairs the most. Dollar Swiss and euro, they have, well, particularly the euro, it's got more liquidity. You got more control over the execution. It's not going to be fickle. Dollar Swiss has got less liquidity than euro. and then there's the dollar index. So it's really a matter of picking the instrument that you feel most confident with. Okay, they will all move. But once again, it's just a simple equation. If you are new to trading and you don't understand what I'm talking about, is if the numbers come out below 4.6, okay, the US dollar falls off dramatically, okay, and that downtrend continues. That has got to be your preferred outcome because it goes with the recent trend in the dollar. Now, as a bit of a counter trend though, because of where these instruments are technically, a number above 4.9 will see a lot of stop losses taken out. It may not be like the big change of the overall trend, but you will get a clean out of trade. So to me, if I'm sort of planning the trade, right, a number below 4.6, I'm going to have a bigger take profit, maybe with a more structured trailing stop system. If it comes out above 4.9, right, I'll probably have just a normal regular take profit because the trend is already down. This is going against it. I know it's a big number, but it won't get the big run-on effect that will have the same impact as it will if the instruments are trending. All right, so that's pretty much it. There's no need for me to sort of complicate things here. It's a simple case of finding your instrument, tune up your charts, look for the numbers. Don't freak out when the numbers come out. You can be trading this live. You've got more control, but if there's variance, you're not going to be able to get in because it'll move too quickly. So maybe, okay, if you had a choice, maybe break your trade up, trade some live if you have the opportunity to be in front of the screens, and then put some of the position or the risk in a pending stop entry order on the downside or top side, and that's where the cash is going to be, right? Believe me, this is a really cracking opportunity. The market's been on hold waiting for it. There's no chance to hesitate here. It's you jump in and you go for it, right? Just remember, follow the process, right? And most importantly, don't trade this event with more capital than you can afford to lose, right? That's the first thing. When you go in and you're setting a stop loss up, you'll know exactly how much you're going to lose, and you can't go beyond that. Otherwise, it will screw up your account, and psychologically, you'll be a bit messed up there as well. Just on finishing up these risk reversals too on the euro, okay, they're sort of been going up and down, up and down. If anything, starting to trade sideways. The market is evenly positioned here for a move up or down. Okay, so let's see how we play out. To me, weaker US numbers is the best outcome, and fingers crossed we get the result we're looking for. All right, guys, good luck. All the best. Cheerio.